Hi everyone, I'm Amira from KGI Securities Singapore. I'm back today with our second half outlook for 2020. I know it has been a while since our last video, but we haven't actually been able to come back to the office to film for you. But I hope you guys have been staying safe. We've been quite busy the last few months. We've had our corporate access events through Zoom. We've also published quite a number of reports and initiations as well. Our most recent ones being Saucer REIT, Yan Not Land, two healthcare providers in Singapore, Singapore ONG, as well as Singapore Medical Group. And our most recent initiation was on Silver Lake Axis by our very own in-house tech analyst, Kenny Tan. We will be hearing from him a little later on, so do make sure you keep on watching if you're interested in what he has to say about the technology sector, as well as some of his top picks for the rest of the year. Anyway, let's get into a little bit of a macro picture first. I think we do still expect the environment to remain relatively favorable for equities and precious metals, as global central banks continue to provide ample liquidity to support the economy in the second half of the year and possibly going well into 2021 as well. Governments of major economies have also indicated that the government will be in support of another round of stimulus measures to help companies as well as provide incentives for employees to go back to work. But of course, I think despite all the government support and quantitative easing, I think this is a crisis like no other, and we will continue to expect to see more bankruptcies, retrenchments in the coming quarters. And I think also the upcoming second quarter results will serve as a very harsh reality check for the markets, but it could provide for a pretty good buying opportunity for investors if you do select your stocks well. But at this point, I think we've seen quite a strong rebound over the last quarter, driven mainly by the technology stocks. Which has been and I think will continue to be a major disruptor for many sectors, including tourism and even commercial property demand. I think this would be a good time to pass some time to Kenny Tan, our in-house tech analyst at KGI, for him to give you some thoughts on the sector as well as some of his top picks going into the second half. Thanks.
We are more than halfway into 2020, and we know for a fact that technology stocks have led the rebound, as we see the Nasdaq trade at all-time highs. This has been a rather fair outcome, given that COVID-19 acts more as a catalyst than a setback for most tech companies. We find the share price rally from semiconductor-related companies to be more unique. We see that the Philadelphia Semiconductor Index, or SOX, is trading at an all-time high as well. It seems that investors are pricing in a recovery for 2020, and the early numbers show, regardless of it being semiconductor chips or semiconductor capital equipment. On our end, we have 4 new tech recommendations. Well, actually 3 new recommendations, as we see AEM as a top performer going into the second half of 2020. All players in the system level test industry continue to produce good results. The focus on SLT is increasing, as competitors start to take note of the opportunities. AEM has been working with SLT for more than 15 years, and we think they have good odds of taking a fair amount of market share in this growing business. Our next recommendation is Silver Lake, which we have initiated on recently with a target price of 30 cents. Make no mistake, the business conditions for Silver Lake are definitely tougher than before. Banks are very likely to cut their IT spending, and tax subsidies from the Malaysian government have started to trickle down. However, investors seem to have undervalued the stable cash flows and strong customer relationships that Silver Lake has. Furthermore, Silver Lake still sees business opportunity from its growing insurance SaaS business, as well as potential contract wins related to digital banking. Third, we have ISDN, an engineering company that specializes in industrial automation equipment. The industrial automation sector has been in a prolonged down cycle, which was made worse by trade tensions and COVID-19. We think China will be the country to revive automation spending. In fact, there are a number of automation peers that reported decent results from China and expect a positive China outlook. We think ISDN, which has about 2/3 of sales from China, could stand to benefit from the next upcycle. ISDN also trades cheaply at roughly 8 times price earnings and 4 to 5 times EV/EBITDA, so there is a strong margin of safety. Lastly, we see Franken as another fairly safe investment with a target price of $1.01 based on 10 times of this year's estimated earnings. Franken's key semiconductor customer, ASML, is doing very well, and we expect strong lithography system demand to spill over into Franken's results. Franken also has a well-diversified customer base, counting customers such as Seagate and Thermo Fisher, and will continue to benefit from long-term trends such as 5G and the proliferation of cloud services.
Thanks, Kenny. That has been insightful and I hope helpful as well for all our viewers. But other than the tech sector, I think we do have a couple more picks that we think are worth taking a closer look at. Mainly those with slightly more exposure to China, as well as a few unicorns in the consumer and healthcare sectors. We are going to recommend taking an overweight position on China and Hong Kong for the rest of 2020 and underweight the US, mainly because China's economic recovery has been coming along pretty well, and they've also managed to contain the coronavirus with the help of harsh lockdowns, strict enforcement of safety measures, as well as widespread testing. Even though there have been some concerns about a second wave, I think the Chinese government are now much better equipped and much better prepared to deal with any further clusters of outbreaks. The US, however, has been getting a little out of hand, if I may say so, with infections being back on the rise since the reopening of the economy. So much so that some states have also reimposed lockdowns or curfews as well. IMF's revised global GDP growth forecast in June show that they do expect China to be the only major economy to clock a positive 1% growth in 2020, while the US economy is expected to contract by 8%. China has also provided for a more solid foundation for growth with its policies and government spendings focused on new infrastructure expansion such as 5G networks, AI, data centers, new vehicle charging stations and the like. And even looking at valuations, China and Hong Kong markets are actually looking more attractive with the Shanghai Composite Index and the Shenzhen Component Index trading at relatively large discounts. The Shanghai Composite Index was just trading at above 17 times PE compared to its last high of 25 times in 2015. On the other hand, US markets are looking relatively expensive. Specifically, the Nasdaq Composite Index has overshot the upper bound of one standard deviation, exhibiting one of the largest disconnects between the economy and the equity markets. Given the dismal 2020 outlook and how the containment of the COVID-19 is going in the US, I think we do expect a correction there in the near term. But stock picks riding on China's growth, we have Yanlord Land for its strong May 2020 pre-sales figures and a steadfast property market. Yanlord's 6 months 2020 pre-sales data represents a 65% growth year on year, but we do think actually that they will likely be able to exceed the targets they've set for themselves this year. Trading at less than 0.5 times price to book, it remains at a steep discount. It still has some way to go to our updated $1.45 target price. We also like Saucer REIT, who has been able to thrive despite the online shopping disruptions because many shoppers are actually still reluctant to buy big ticket items online. Not only that, with a slowing economy, many are also more likely to want to shop discounted goods, boosting retail outlet spending. Also, with downside protection from a fixed income component and expectations for more stimulus from the Chinese government, we are positive on Saucer's performance in the second half of the year. If you don't like retail or if you prefer to invest in China's booming e-commerce industry, we do recommend EC World REIT, whose e-commerce logistics assets represent about 40% of the REIT's portfolio. With a strong sponsor and partners Alibaba and Fosun Group, we believe that EC World is well positioned to capture vast growth opportunities in the coming years. Moving out of China, our two other equity picks are Singapore Medical Group and Thai Bev. Singapore Medical Group, or SMG, has been aggressively and successfully, I might add, expanding beyond the Singapore markets into the Vietnamese, Indonesian and Australian healthcare markets, which we think will truly be a boon for the group in the coming years. Do read our initiation report released July 8th to find out more. But again, we strongly believe that SMG is primed for success in partnership with its largest shareholder, CHA's Healthcare Singapore, an international subsidiary of leading Korean healthcare group, CHA Health Systems. We also remain positive on ThaiBev's dominant market share in Thailand and Vietnam and its long-term fundamentals, given that its key markets are ranked among the top alcohol-consuming countries in Asia. Our Thai economist also actually expects a strong rebound in the economy in 2021, swinging back to a 6.8% growth following a contraction of 8.4% this year. Our target price for Thai Bev remains at 96 Singapore cents, representing about a 40% upside from its current price. And finally, let's talk about some gold and crude oil, the best and worst performing assets year to date. We've been closely monitoring gold and silver in the last few months, and we maintain our target price of 1,900 USD for gold in 2020 because the zero and negative interest rates environment and the recurring trade and geopolitical tensions it continues to make gold a very attractive investment for many investors. On the other end of the spectrum, with businesses yet to recover to pre-COVID levels, demand for oil has been deeply affected. Add on the extra output from the price wars in March and April, crude oil has been one of the worst performing commodities. That said though, the EIA has projected global oil supply and demand to balance out from the third quarter of this year, and ultimately those who do survive the downturn will emerge stronger. Therefore, we reiterate our recommendation of CNOOC from our previous Outlook report with a target price of 10.04 Hong Kong dollars. It is currently the only oil major with a net cash position, and its price to book ratio is at a historical low of 0.8 times. I think that's all for me today, and with that I'm going to stop rambling your ear off, but before I do, I will emphasize this again. While we remain positive on the equity markets, stock selection is key to outperformance in the second half of 2020. It is still important to select companies with strong balance sheet to account for the inherent risk that demand may not recover as quickly as we expect it to, or if a second wave potentially emerges as we approach the winter months in the US, China, and Europe towards the end of the year. We hope you found this video helpful. If you did, do remember to give us a like or just drop us a comment down below. I will link the full Outlook report down in the description box as well. But till next time, please take care and stay safe.